Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Coming in hot on the heels of this 4th of July break, we have Jeff's monthly review and outlook for July, which is available on Substack at hugeinsights.substack.com. And of course, don't forget to like and subscribe to Your Finance TV to stay on top of our content as well. Jeff, welcome back. I hope you had a fantastic July 4th celebration.
Thanks, Mehdi. Had a great weekend, and likewise,
I know it's
great to be
crazy.
here.
It's like this midweek, this split kind of long weekend, which has been which is kind of fun, confusing but fun. But I'll take it. These weeks are great.
Yeah, exactly.
But obviously, we have your monthly piece, so there's lots and lots to talk about. So let's dive right in. I'd love to kick off as usual with the top down.
Yeah, Monday was a shortened day, and we didn't have a lot to do in the market, but we spent some time just kind of dissecting the S&P 500 just for fun. And what we learned was that while the S&P was up around 17% year to date through the end of the quarter, only about 28% of the stocks in the S&P 500 actually beat the index's overall return, which speaks to the fact that, again, we've got these magnificent seven stocks that have led the way. But when we dug a little bit deeper, we noticed that only 24% of the stocks of the S&P 500 were actually up greater than 20%. And of course, 20% is an important number to, the media and many other people who like to, talk about up 20% is a new bull market. And that seems to be what's being, bandied about in the popular press. The other stat that kind of jumped off the page to us was that 58% of the stocks in the S&P 500 were actually up less than 10%, and 35% of the stocks in the S&P 500 closed the quarter, half year, and month in negative territory. So when more than a third of the stocks are negative for the year, it's tough to claim we're in a new bull market. But, we'll let them say what they want to say.
Well, excuse me. There's definitely a lot of figures and statistics to digest there. My head's still spinning, but as we continue the conversation, I'm going to try and digest all of that. Let's dive into your slide deck. We've got a bunch of stuff here today. Last month, your strategic risk model was definitely a neutral, indicating 50-50 stocks versus bonds. Now it's more on the offensive, moving 80-20 in favor of stocks. Are you becoming any more bullish on stocks, or is this just a model kind of managing itself?
It's a relative call. So it's stocks versus bonds. And the model really looks at the S&P 1500 stocks on an equally weighted basis and the corporate bonds of those 1,500 companies on an equally weighted basis. And it looks at that ratio, okay? And the model's got a pretty good track record of being correct for long periods of time. We got a negative reading in April. On April 30th, we confirmed a negative reading in the model, which took us from overweight 80-20 allocation to 50-50 neutral. June 30th, we confirmed a positive signal in the model, and that moves us back to 80-20. It's basically saying that, stocks should outperform bonds. It doesn't necessarily mean stocks are going to go up dramatically from here. It may simply be signaling that, we're starting to see more credit issues develop in the corporate debt world, or it may be indicating that rates are likely to move a little bit higher.
Got it. And last week we also looked at the cycle composite. So let's revisit that and how things are looking on that side.
Yeah, so the cycle composite line, which is the heavyweight blue line, is the expected path and performance of the S&P 500 based on three equally weighted cycles: the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. Now, in this work, Ned Davis has created this composite, and they suggest that trend is more important than performance per se. What we saw basically was the S&P 500's actual path deviated quite sharply away from the expected path in the first quarter, but then kind of resynchronized with that expected path. And we're now coming up to a point in the expected path where stocks are expected to top based on those three cycles. And the exact point of that top is, basically right now, the first half of July. And as we know, these, the actual path, which is the gold line, the gold dash line, it's not going to follow it exactly, and the peaks and troughs are going to come slightly ahead or behind where they're expected. But at the end of the day, we're kind of in that zone where stocks are expected to peak based on the cyclical work, and they should be in a sideways to down sort of trend through the end of November. So I think this period from July to late November is going to be a period of at least consolidation, if not something far worse. And so based upon what we're seeing in the cycle composite, we're basically not suggesting that there's a lot more upside to the market. In fact, as you know, we've been indicating that, and our work has said for a long time, that we're in a counter trend advance, and that counter trend advance is likely near a point of termination, and that the next wave down should carry the market to new bear market lows. We'll see if that plays out. So far, we've been less than correct in our prognostication. I think it's simply just because, the rally itself is extended. It's still a corrective waveform. We don't see any we don't see any impulse pattern developing here, which is the indication of a new bull market. We don't have an impulse pattern to point to say, look, we've got a bull market on our hands. It's not there. It doesn't exist. What we have is a very corrective waveform, and it's an obvious three waves up. And we're counting it as a double zigzag. We'll talk about this more in more detail. But at the end of the day, I think we're topping here, and I think the cycle composite is evidence to that fact.
So a topic that's been on everyone's mind is recession, and we've discussed this over the last several weeks and months as well. One of the charts in your chart book this month, is actually really interesting. I kind of love this chart and this data point. It's declining cardboard box shipments and how they've preceded recessions. So how are things looking based on that? And also, could we just be seeing more efficiency in the way people are packing their cardboard boxes?
Very doubtful on the latter point, but my suspicion is this. Okay, it's an oft overlooked recession indicator, right? The decline in cardboard boxes, at least for the past three recessions, we saw a complete collapse in cardboard box shipments, into the 2001, 2002 tech wreck recession, into the great financial crisis, into the COVID collapse. And now we're seeing the lowest cardboard box shipments that we've seen since the great financial crisis, which is indicative of a period of recession. Some have argued that, well, we're just in a manufactured goods recession, and that the economy has shifted more to services, and people are traveling, they're buying experiences. It's 70% consumer economy, not a goods economy. But we got to understand that it's production that drives GDP growth, okay? It's the production of new cars, it's the production of homes, it's the production of manufactured goods that actually drives gross national product, okay? And so, when we think about, cardboard box shipments, well, every manufactured good on the planet is shipped in a cardboard box, okay? And if cardboard box shipments are in decline, then that suggests that manufactured goods production is in decline, and it's confirming everything that we've seen in the manufacturing PMI numbers that have come out recently. Most recently, I think the other day at 46.46. Anything below 50 shows a contraction, right? And so we are seeing a contraction in manufacturing in the U.S. It's not quite there yet in services, but it's not far away either. So it's not as though services are pounding out new highs, right? They're not. They're hovering just above that delineation between contraction and expansion. And so we look at this as another check mark in the recession camp, right? That suggests that, well, gosh, we've got lots of anecdotal evidence, but this is hard data, right? And this is hard data that doesn't change on a dime. It takes a long time to reverse this trend. And my suspicion is that we're not even at the lows at this point.
Well, I love those types of anecdotal, hard data kind of points, which are slightly out of the normal box. So we'll definitely keep an eye on that. While on the recession conversation, how's the economic dashboard looking? Is it still indicating a recession on this side as well?
Well, we look at the leading economic indicators index. It's been a tried and true measure of economic fundamentals, right? On a forward-looking basis, not a trailing-looking basis, or even coincident. So, one of the things that's interesting to me is that we broke below the -4% line about a year ago. It was in August of last year, so we're coming up on that 1 year anniversary. Usually, when you get 2 consecutive months of negative LEI index performance, year-over-year growth, that is, below 4%. It's got a 100% track record going back to the history of the data of predicting a recession within the next 12 months. So, we got that in August of last year. So, based on that, if we look at the averages, the average recession began 8 months following that second -4% print. And that would put us squarely in the second quarter, right? So our thinking at this point is that the US economy may have actually entered recession late in the second quarter, but it's not showing up in the data yet. We're not getting June data yet for a lot of hard stats. And so I think when we start to see third quarter data roll in, we're going to be very clear that things began to trend down in the second quarter and started to move more significantly to the downside in the third quarter. So, I think when the NBER comes back and actually dates the recession, they'll likely date it beginning late in the second quarter based on the history of this. Now, it's possible that, it's going to be in the third quarter, but, we're working with averages here, right? So anything's possible. It could be late. And it seems like, the yield curve has just started to re-steepen on a 3-month, 10-year basis. Another indication that recession is now not just looming ahead, but possibly in process. And so, I think there's a number of indicators that are indicative of recession right now. Another that we've been talking about for some time is lending standards, which have tightened up dramatically. And a lot of these factors are captured in the LEI index data itself.
So the other dinner topic is outside of recession is inflation. So looking at the inflation side, it feels like things seem to be easing a little bit in some of the data, but how's the inflation dashboard looking?
Yeah, well, if we're just going to be objective about it, use the inflation dashboard and focus purely on core inflation, which is what is important to the Fed, then we got to come to the conclusion that, yeah, it's easing, but it's still dramatically above the Fed's target rate, right? So the Fed has 9 separate calculations. These were developed by the various Federal Reserve banks around the country. Number of them, like the Cleveland Fed and the San Francisco Fed, have a couple in there. There's a few banks that don't have any. But at the end of the day, we've got 9 calculations, right? Those 9 calculations give us, a better view at what core consumer inflation is than just taking any one of them by themselves, right? And the thing that stands out to me is that 5 of those calculations are now printing at year-over-year growth rates that are substantially greater than what prevailed, 12 months ago. So, we're still printing year-over-year inflation growth, right, or expansion in inflation. So, the point is we can focus on core PCE, which, Alan Greenspan kind of dubbed the Fed's preferred, measure of inflation. I don't know if it's still the Fed's preferred measure of inflation. The core CPI seems to be getting a lot of attention too, and there's a lot of other ways to look at it. And so, if we take the aggregate of these 9 and just average them out, we're about 371 basis points above the Fed's target right now of 2%. That puts us, 5.71% is where core inflation is, right? And when we think about, what Fed policy looks like right now, there's about an 84, I think 86 as of this morning, 86% probability that we're going to see another 25 basis point hike at the July 26th meeting. Now, what does that mean? Well, that puts us up to about 5.5% on the Fed funds rate, which still is below 5.71% on core PCE. Now we're going to get another look at, I'm sorry, core inflation, rather, the aggregate average. We're going to get another look at data through June before we actually see, before the Fed actually makes their decision. So I think we get a radically lower print in core inflation. By radical, I mean, 25 to 50 basis points below where we're coming in right now on average. Then I think it's possible that the Fed decides to, remain on hold, right? But at this point, it looks pretty likely that they're going to raise rates at the July 26th meeting. Almost every Fed governor out there has been implying that in their public comments. And Jerome Powell has been pretty adamant about the fact that, they're data dependent, but this pause was a one and done, and that they're back on high alert for, evidence of inflation.
So, Jeff, this is your monthly piece, obviously, and you dive into multiple asset classes, regions, have an overall thought on portfolio positioning. In regard to the fixed income side, would you say you still favor short duration versus long inflation short duration versus long duration, inflation protected over fixed rate, and low quality versus higher quality? Is that fair to kind of recap your positioning in those?
It is. Yeah, that sums it up perfectly. And a couple of those are on watch for a reversal. But what we basically do is we create a ratio chart of short and long duration, for example. And basically long duration bottomed in the first quarter of 2020, and since that time, we've seen that ratio trending sharply higher, meaning that short duration has been outperforming long duration since that time. The same is true of inflation protected treasuries versus coupon bearing treasuries, right? So tips over coupon, fixed rate treasuries. And, the tips have been outperforming. Now, in recent weeks and months, we've seen a consolidation develop in both of those relationships, but the trend continues to be intact. And so as long as that trend holds intact, we want to continue to favor those. But, they have been on again, off again, on watch for a reversal. Right now, we're kind of neutral on that. The interesting thing about low quality versus high quality is that, yes, while low quality has been outperforming high quality in the ratio study, we are also looking at, low quality bonds, or high yield debt, if you will, versus the S&P 500. And as the S&P 500 has made, its recovery highs, we have not seen higher highs out of high yield debt. And, basically high yield debt are stocks in drag, if you think about it, where it comes into play in the capital structure, and they tend to trade in line with stocks. But we've seen, an intermarket non-confirmation out of high yield debt. And as a result of that, it keeps us, concerned, about equities, okay, but also about our low quality call. It could very well be that this is a precursor to a reversal. So that is the area that we're watching most closely for a potential reversal.
Got it. Thank you for that breakdown. So we've discussed the tightness of this rally ad nauseum, but it plays to both the bulls and the bears in many ways. One questions the quality of the rally, and the other says we have room to catch up on the other 5,000 names. How are things sitting with you?
Well, a couple of observations. First of all, the Magnificent Seven posted a 19.6% gain in the first half of the year, right? The S&P 500 posted a 16.8% gain in the first half of the year. What that is implying basically is that the S&P 493, in other words, the other 493 stocks in the S&P 500 actually posted a negative aggregate return. In other words, on a weighted average basis, they were down 2.8% for the year. And so there's really, a handful of stocks, 7 stocks that are driving the index's performance. That's not to say that all 493 stocks were down. That's not the case. Only 35% of those stocks were down, or about 175 of the 500 stocks in the S&P 500 were negative on the first half of the year. But the point is that we've got this kind of bifurcation, right, between the haves and the have-nots within the stock market. There are a number of mega cap technology issues that are perceived to be either safe havens or big beneficiaries of the AI revolution. Whatever your thesis is, you've been piling into these names, and as a result, those names have dominated the performance. And there's a lot of action in the options market, which we can talk about as well. But that has a driving force behind it as well. So at the end of the day, if we think about market breadth, 49% of the stocks in the or actually 49% of all U.S. stocks are now trading above their 200-day moving average. And if we think about the implications of that, it says that breadth is expanding. Okay, a month ago when we were having this conversation, only about a third of the stocks in the U.S. were trading above their 200-day moving average. So we've seen some improvement there, but it's still below 50%, and it's still not 60% or 80%, right? Most stocks are not above their long-term trend, okay? And so, we kind of think about it that way. Now, another way to look at it is new highs in the month of June. And if we think about new highs in the month of June, we saw 393 new highs versus 92 new lows. That would suggest that new highs are beating new lows on a 4-to-1 basis during the month. So, that's a positive as well. A lot of it could be due to sector rotation, and sector rotation might be a function of rebalancing at the end of the quarter or mid-year. Also, there's the Russell reconstitution. And, many pension funds and, international funds are rebalancing their exposure to equities in general and sectors within those equities. And so, we think that a lot of it can be explained by sector rotation and rebalancing.
So let's have a look at some technicals, Jeff. With the recent moves, have your levels or views changed much, or are you kind of like still in that same kind of band in the universe?
Yeah, so to be perfectly blunt about it, the market has extended further than we originally expected. About 300 points on the S&P above where we expected it to be. Our call was for about 4150 or so as a counter trend advance off the October lows. When we got to around 4200, the market stopped. And if you take a look at the very broad market, not the S&P or the NASDAQ, but broader measures like, for example, the Value Line Geometric Index, okay, which is 1,700 stocks. 90% of the revenue in the U.S. is captured in that market, and that index actually goes back to 1961, and it's an equally weighted index of these roughly 1,700 stocks. And what it measures is the median price change every single day, and as opposed to the average price change. And that index topped in February, right? So the vast majority of stocks topped in February. Now, what happened is we had a slight crisis, banking crisis. Everybody remembers that back in March. And, stocks sold off aggressively. But what didn't really sell off were the Magnificent Seven. Those were deemed safe haven stocks. Money flowed back into those names. They were kind of the balance sheet, fortress balance sheet names that people felt, well, if the banking system collapses, We don't know what's going to happen. These stocks will survive because they're heavy on cash, low on debt, and they have got defensible sort of revenue streams, right? So the idea was that those would be the companies that would survive. And so then we heard about AI, right? AI came back to the fore with NVIDIA's quarter, and money poured into those stocks because they were deemed to be the beneficiaries. And these stocks carried the market now to around 4450 in S&P terms. But the vast majority of stocks have not broken out above their February highs. In fact, the average stock in the S&P, the equal weighted S&P, has not taken out its February highs. The Dow actually put in its recovery high on December 13th. Now, maybe it will take out its December 13th high, but so far it hasn't. Okay, so, when we talk about the technical condition of the market, most people are talking about what's the trend of the S&P 500. Well, the trend's up, okay? The trend is up off the October lows. There's no question about that. But our work suggests that it is a counter trend advance. We don't see an impulse wave here. We don't see a bull market evolving here. What we see is an impulse wave to the downside that ended on October 13th of last year. And since that time, we've seen a counter trend advance, a corrective waveform that is now extending beyond the 2/3 retracement level and may actually push as far as the 786 retracement level. That's a common Fibonacci level. It's common with second waves, and we believe this is a second wave. And so that level comes in at 45.34. If the market continues to push higher, it will likely challenge the 78.6% retracement at S&P 45.34. However, that's not required, okay? We've seen enough evidence that the market is topping now that we're not that sure that it's going to do that. We think regardless of whether it hits S&P 45.34 or not, the next directional move, major directional move for the S&P 500 is to the downside. And this should be primary wave 3 down. And that should carry prices to new bear market lows that substantially take out the October lows by a wide margin. Our minimum downside target for primary wave 3 is S&P 2750.
2750, got it. Let's talk about volatility for a moment, Jeff. We discussed this in the special a couple of weeks ago with Jim Struger and yourself. But can we talk about volatility spikes that you potentially, both of you actually expected, and it's how it's all tied into a gamma squeeze or potential gamma squeeze?
Yeah. So the chart we're showing here illustrates skew in the upper frame and the VIX in the lower frame. And basically, I would put it very simply this way: the VIX is underestimating risk in the market in terms of short-term volatility. And the reason for that is that there is a gamma squeeze on these Magnificent Seven stocks, right? 0 days to expiration options have really taken over the market, right? It's the tail wagging the dog for all practical purposes. And, day traders are buying, optionality 1 day at a time on these stocks, and it's or the market, right? And because it's a passive market, money's just flowing into these stocks because they dominate. They're 26, 27% of the S&P 500 at this point. And so it's forcing the market makers, every time they're lifted on a call option, they need to buy these 7 stocks in size in order to remain delta neutral. And that's created basically a gamma squeeze in the market. Now, the upper frame shows skew, and skew shows that, market participants are starting to hedge their tails in a big way. They're starting to be really concerned about, an event that could squeeze that, that could reverse that gamma squeeze and force volatility higher. And so, volatility has been artificially suppressed, and any down, meaningful downtick, say a 5% decline in the S&P 500 could result in a big spike in volatility. It could carry volatility from, this 13% range up to, say, 18 to 20% without much effort. Now, generally skew is considered kind of the black swan alert, right? There's maybe close to around a 15% probability of a black swan when you get up around 150. 100 is normal, and that would imply about a 2% probability for a black swan. So black swan's an unexpected event that causes downside move in the equity market, right? An unpredictable event. I don't know that you're necessarily going to get one, but there's lots of them potentially floating out there. And so, I think basically the market's set up to see these alligator jaws snap shut. Some type of an event that results in the equity markets declining by, say greater than 5% or maybe even as much as say 10%, would spike volatility to levels that I think would take out the prior highs. Prior highs being kind of the mid 30% area. I think we could easily get to that level. And, we haven't printed anything over 40% in about 2 years. I think we're due for it. I think we could go somewhere into the mid 40% or higher range with the next big volatility spike.
I think there's a lot of people in that same camp that are expecting a nice volatility spike. There's a sense of agreement in the fact that, excuse me, earnings are quite priced in and valuations are certainly quite rich. Are we firmly capped at these levels or at least close by?
Valuations are a function of what earnings are, right? Street expectations are for 220 this year, 246 next year, and an absolutely ridiculous 274 for 2025. I don't even know how you can start projecting 2025 estimates. We've only seen first quarter 2023, and they were down, not as bad as everybody expected, but second quarter expectations are for down 8% on a year-over-year basis, and down sequentially as well. And so I don't know that you can really get too excited about 2025 earnings. We're actually forecasting 207 this year and 187 next year. That puts us about 6% below consensus in this calendar year and 32% below consensus next year. I don't even think we're the low on the street anymore. And it wouldn't surprise me if earnings came in way below that. I mean, if we're in a recession next year, the average earnings drawdown in a recession is 29.5%. And that includes, of course, the great financial crisis and the tech wreck. If you kick those two events out, then the average of the last 10 recessions is, negative 18.5%. So I'm looking for something that on balance looks like down 15%. I think we could definitely exceed that to the downside. If I'm wrong, I'm still too high. But valuations right now are in the 10th decile across the board, whether you're looking at, PE on forward operating estimates, which, I think are wrong. And if you just kind of use our estimate, you're looking at something like 23 times forward 12-month earnings. If you're looking at the Shiller CAPE ratio, we're at 31 times. If you're looking at yield, we're at 1.5%. If you're looking at price to sales, we're at 2.5 times. If you're looking at price to book, we're at 4.3 times. All of these measures are in the top decile of valuations in history. Well, back in my Leuthold Group days, we did a study on forward 10-year returns for U.S. equities based on the S&P 500 for each decile. And lo and behold, when valuations were in the 10th decile, the returns were the worst for the forward 10-month period. In fact, in nominal terms, they averaged 3% annually for the next 10 years. So if you think about it from that perspective, and you think about the 10-year bond yield at 384 or so right now, it looks to me like 10-year treasuries are a better value than equities for the next decade.
Got it. Jeff, this has obviously been quite a deep monthly, as always. And before we head off, are there any sectors that you want to discuss that jump out at you?
Well, there's one that we upgraded, and that's industrials. When we look at sectors, we look at them on a relative basis, and we look at them on an absolute basis as well. And from an absolute perspective, industrials broke out to a new all-time monthly closing high. And so it's the only sector of the 11 gig sectors that has posted a new monthly closing high. And that actually tripped our criteria and forced an upgrade from neutral to bullish on industrials. Now, from a relative perspective, we hit a low and we've turned up off that low. That's not really definitive at this point, but we are, coming off a low, and it looks like we could get a nice relative bounce. Momentum is also turned up, and so all in all, I think the real surprise should be in the industrial space, and we're seeing a lot of stocks that are showing evidence of pretty strong recovery. Of our 5 recommended longs, I think 3 of them are industrial companies this month or this week. So, basically, I think industrials have a lot of potential if you're betting on the long side. And I think they will likely be outperformers.
Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights.
Always a pleasure.
And for our viewers, I want to urge you to check out Jeff's content on Substack at hugeinsights.substack.com. And as Jeff mentioned, he's still publishing his top longs and shorts for the week and a month. So you can find all those there. Until next time, good luck investing.